This example begins with crude oil futures continuously climbing over the course of a few years. The break of an upward channel eventually leads to a sustained decline. A stable and strong downtrend due to the series of downward continuations, which when seen on a smaller scale, are great examples of the three methods falling candle pattern. This hybrid of harami and bullish engulfing also demonstrate the same general price action of a morning star, which leads to a significant upward reversal. Like previous examples, there are relevant resistance ranges and levels that originate from the downward continuations, especially from the larger candles that form the beginning and end of three methods falling patterns. More three methods falling and general downward continuation price action, all of which originates from a harami in a more bearish context from the 66 resistance. In some ways, the first two phases of a downward continuation and three methods falling are somewhat like a harami due to the resting phase candles almost contained fully within the real body range of the first candle, which is very much like the mother candle of a harami. This provides a neutral to bearish tone before the final candle brings back the original bearish conditions in a similar fashion to a bearish engulfing pattern. Down here, a pair of piercing patterns forms a double bottom for a sizable bullish reversal. As expected, the previous levels continue to influence the market well into the future. Remember, candle patterns are essentially summaries of price action, charts within charts. Combining time frames demonstrates this well. The 15-minute chart in the intraday on the left demonstrates a shorter-term perspective, while the daily chart on the right demonstrates a longer-term view, which highlight the general greater importance of opening and closing prices, especially for the first and last candle in a falling three methods that establish the main structure of the downward continuation. A look at a longer-term perspective over several years reveals the same general price action except on a much larger scale that still results in a downward continuation. Another example where a bull hammer that is even bullishly engulfed does not lead to an upswing, but rather slows down an overwhelming downtrend. Later on, there are several haramis that lead to a neutral to slightly bullish range. However, this is more of a passive rise in response to the downward overextension, especially from this final gap down and sell off below the key 32 area. And a few weeks later, the exact same concept with another relatively passive rise in response to a major downward overextension during the historic negative crude oil futures prices, which does form a large harami that is more bullish. The second candle is concentrated more towards the upper half of the first mother candle, and when the two candles are combined, they effectively form a large bull hammer with a very long lower wick rejecting those negative prices. As expected, once the market begins trading and closing above the high of the harami, which just happens to be the lower boundary of this previous range, a sizable uptrend emerges. Naturally, this historic volatility led to the candles of the next few months appearing relatively stable in comparison. And there is natural influence from the gap down and gap fill levels which continue to influence the market well into the future.